DFJ, Draper Fisher Jurvetson, is a Silicon Valley-based venture capital fund that started in the early 80s, and we manage about $3.3 billion US, and we have 3 main offices around the world: Menlo Park, Shanghai, Mumbai. But DFJ also has a very unique business model. It has a network of affiliate funds through which we manage actually $6 billion in total, and have a presence in about 33 cities around the world. And for DFJ US, we originally, as many other VCs, was quite focused on TMT sector, and some of our earlier successes include Hotmail, Skype, and many others. And in China, we actually started here in about 1999, and we founded Baidu in 2000, and Kongzhong and some other successful companies in China. And we have about 11 portfolios companies in China, and we have been quite focused on clean tech in recent years. And DFJ Global actually has started looking at the sector things about 10 years ago, and we have about 40 companies in our portfolio around the world. And in China, we have 3 out of 11. So 2 of the most recent transactions we've done in China actually are in this space. They are all in, they're both in energy storage space. And the number 3 clean tech company we have is doing blades for wind turbine. For wind power, and it is the largest one in China, and the second largest in the world. So we believe, in clean tech, the biggest trend we think will happen in China and around the world, and we also have a strong presence in TMT, and we also look at consumer space selectively in China as well. As I just mentioned, we have invested in 2 energy storage companies in recent months. But to be frank, I think the bar is getting higher for every fund, and we do become more selective when we do deals. And also, as our fund, moves towards a later stage, because the fund now has been around for a few years. So our strategy is also moving from very early stage investments, such as the 2 companies I mentioned before, towards making investment in growth stage companies, which, as Olivia and Harry mentioned before, is quite difficult in today's environment, when you have companies still have valuation expectation as last year or close to last year, but at the same time, some of the companies' forecast has coming down a little bit. So there is a gap between the company's expectation and the valuation we are willing to give, and especially for the good companies, if they have a strong cash flow, especially for late stage company, they are hesitating to take money from VCs.